Hello everybody, welcome back. In today's video, we're going to discuss stocks, indices, inflation, Federal Reserve, earnings season. There are a lot of things to talk about. Let's get into it. Let's start with deflating the bubble concept. So the 2022 bear market sent stocks back to historical valuations. So we were definitely trading at a very high P ratio around 32.5, and we have come down heavily, and now we're sitting at a 20-year average. So you would think the market's now feeling cheap, but it's really not. You are paying really high price for the stocks if you were buying around 2021 time or 2022 September, October, November, December, etc. time frame. Okay, so the market is currently sitting at a normal price, okay, in terms of P ratio. So where do I think the market becomes cheap? When it goes below the average, right? Where do you think the big hedge fund managers and the big market participants are planning to buy the market? Around 15 to 16 P ratio, right? I mean, look at history. Back in 2018, the market liked this level. It was above 15, like around 16 P ratio. The market loved it. Back in 2020 crash, right? It just hit 15p, and then market thinks, okay, it's a cheaper market, I'm gonna buy it. Okay, let's go back to 2004 to 2007 timeframe. We were trading above average, and we came down to 15p ratio, and then market loved that level. Okay, and obviously there are always exceptions like GFC when the market tanked to below 15 and came down to like 11p ratio. Is that going to happen? I don't think so. I do not think we're in that kind of a crisis. Okay, so if the market comes down below 19p ratio, like if we start getting to 3,500 or 3,200 on the S&P 500, I think we're going to be around this 16 to 15p ratio. And at that time, definitely, I'm going to update everybody. We may see a big bottom in the stock market if we get down to those levels. Okay, so definitely subscribe to the channel for that. So the markets have come down heavily because of rising inflation. I was expecting this June CPI report to show some signs of coming down, but it definitely did not. Okay. So currently we're sitting at 9.1% inflation in the US. So what does the market think of inflation? Okay. So we're going to look at the 10-year break-even inflation rate. So the blue line is what the market thinks the inflation is going to do. And the red line is basically what inflation is currently at. So back in 2020, we know that market was thinking inflation is going to go up, but inflation took actually some time to go start really going up and catching up to the market. Okay, right now what market thinks is inflation is going to come down. You can see this blue line peaked somewhere around May timeframe, April to May timeframe, and it's been coming down since then. So the inflation is going to come down. That's what market is telling us because it's leading indicator. Have we seen signs of inflation cooling down yet? No. Okay, we just saw 9.1 reading, which is really high, but it may take some time. But I think the market is already telling us inflation is going to come down either in next report or the one after that. But do I think it's going to show up in next report? I think so, yes. And why do I say that? Because if you look at the daily national average gasoline prices, this is a big part of the CPI. Okay, how much are we guys paying for the gas? So I know here in Midwest, I'm paying around 4.74, $4.74 gas price for unleaded fuel, and the national average is actually going down. I mean, you see back here in June, it peaked and then it started going down. So if I'm starting to feel that I'm paying a little bit lower for the gas prices, then I can tell you that yes, next month the CPI report, which is consumer price index, like what am I feeling, is definitely going to show some signs of cooling down. And this gas price, this chart is basically telling me that. That's why I'm more sticking or biased towards next CPI report, not as hot as what we saw just for the June. So one way to fight the inflation is basically control the demand, and that's what the Fed is doing. So currently we are sitting at a 1.75% interest rate. So Fed can definitely crush the demand side, but they cannot control the supply side. So let's say if you want to go buy a house or you want to go buy a car, they can raise the interest rates in the US, and so basically you will not be able to buy a house because you're going to say, oh my God, the interest rate is like 5% or 6%. I cannot buy the car. So they're crushing the demand. And that's what they would like to do so that inflation can come down. Because if there is too much inventory in the market, then basically the prices will go down. That's the basic economics. Okay. So the Federal Reserve is on a hiring interest rate spree, right? They want to increase the interest rate so that they can bring the inflation down. So currently, we have a FOMC meeting coming up on 27th of July. So before the CPI report came out, before the CPI report came out on Wednesday, 93% of the people were thinking that we're going to get a 50 to 75 basis point hike. Okay. That was this column, 225 to 250 interest rate. Okay. Total. But as soon as the CPI report came out, now as of today, the market is expecting 75 to 100 basis point increase. Okay. So we're currently sitting at 175. Okay. So if you're going to get a 75 to 100 basis point, we may be sitting at 250 to 275. So if we get a 100 basis point hike at the end of the month, market will actually rally. Okay. Because market wants the Fed to control this inflation. Otherwise, it's going to be entrenched in the economy. And we don't want to see that. We want the inflation to be controlled as soon as possible, even if they have to go 100 basis point. Okay. But if the Fed actually goes to 50 basis point, market will not like that. Market may go down. So if the Fed does what the market is expecting, market will rally. Interesting way to think about it, right? The other big thing is that we are getting into the earnings season. So it's very important to be aware of when your stocks are going to be reporting earnings because stocks can make big moves up or down after their earnings. And if you're not sure what I'm talking about, go look at Netflix stock after the earnings. It was a disaster. Okay. So on Monday, we have before the open, the big banks coming out: Bank of America, Goldman Sachs, Charles Schwab. So definitely keep an eye on that. On Tuesday, we have Johnson and Johnson, Netflix reporting. On Wednesday, we have ASML. That's going to give us an indication of where these semiconductors are going. And then after the close, we have the big one, Tesla. So I know most of you or many of you are in Tesla, and we're also going to look at that stock today. So stay tuned for that. United Airlines coming out, and then on Thursday we have AT&T, American Airlines, Nokia, and on Thursday after the close we have Snap. And so, for example, if Snap comes out and has a bad prediction or expectation of their industry, it's also going to affect the stocks in the same industry. Meaning, it's also going to affect Facebook or Meta, and same thing goes for Tesla. If Tesla says something bad about the industry, then it's going to affect other EV stocks that you might have. So, for example, like Lucid, Rivian, Neo, etc. So keep an eye on that, and definitely subscribe to the channels. I'll be covering this every week so that you guys are better prepared for your particular stocks for the earning season. And on Friday, we have the best one is American Express. So that's going to give us an idea of what the consumer spending is like, etc. Let's move over to the stocks and start with DXY first. So US dollar currently is in a nowhere zone. Okay, it's in the middle of nowhere. I don't know where it's going to go. It could go up or it could go down. Okay, if the US dollar breaks this 107 level, then it's very bullish for the market. If US dollar breaks down like this, that's going to be the first sign of change in trend. If it breaks below 107, that's going to be tick mark for the S&P 500 to go up. Okay, but if US dollar comes down to this level and it starts going up, that's when you have to be careful on the S&P 500 because S&P 500 should come down if US dollar does this. Okay, and if US dollar goes up and S&P goes up, then be careful because that may very well be a trap. So talking about the traps, let's go to the S&P 500 because that's where the big Wall Street nasty guys are there. All right, so the biggest trap that they set in the 24-48 hours is the trap right here. So the market was coming down heavily, right? And they broke basically below the key level. Okay, it was coming down and they broke the key level right here and they closed below that. It wasn't even a big, they closed below that and they even went further down and they took some orders because everybody tried to go short, right? You broke a key level. Obviously, you should go short, right? And they grabbed the orders and they just basically reversed. Okay. Then it broke the trend line that I had and then retested that and just went up. Okay. So if you took that trade, if you went on the call side, very good, good for that. But if you guys took, some of you guys took short position, just let me know because I know a lot of you took short positions and definitely you have to be careful when it comes to the key level. Okay. So if you took short, that's okay. Lesson learned. Okay. Move on. So talking about the other opportunities that we may have in the stock market for the S&P 500 traders. Um, so definitely, I feel there's more shorting opportunities than buying opportunities because we're getting the resistance. We're getting this 3880 range, which is a big level for the market. So if the market comes down to this level, okay, we expected some change in trend and maybe we could go lower, right? But if we bust through this, we'll have another resistance at 3920. I mean, we have so much resistance at 3920, 3950 in this area, in this area, this area. So where do you think is the high reward, right? Is it on the short side or on the buy side? Okay, there's not much on the buy side, I think, because you're probably getting maybe like 1 point like 2% max, right? But you have resistance here, resistance here, resistance here, but you have all the shorting side open, right? Market could come down to this level, maybe or maybe not. I'm just telling you where the risk reward is. So let's go to daily time frame to understand where the key levels are and where are we actually in the market. So we're still in a downward trend. Okay, we're coming down, making a lower low. This is the first time that we have changed the trend and stabilized. Okay, we haven't made a lower low yet. Okay, we have made a higher low and we are stabilizing, but we are again going into the key resistances. We have resistance right here, and we have resistance right here, and we have trend line, and we have 50 EMA. We know that's a resistance, 50 EMA, 50 EMA, 50 EMA, 20 EMA, right? Only once we have broken down, we broke above that, but see what happened after that because it was bad. We don't want it to move like V shape up. Okay, so I see a lot of short opportunities. I don't see much of bull opportunities, but if we start breaking above this key zone, if we break above the 50 and we come back and retest and we buy, I'm going to get in the market right here. Okay, because then we're heading up and the risk reward is high. If you go from here to here, we're almost talking 6% or 7% on the market between this range. Okay, so at this moment, I'm not taking any trades until I see some opportunities, maybe in this area or this area. If I see some shorting opportunities, I'll go for it, but definitely not looking for calls at this moment. Okay. So that's on the S&P 500. Definitely looking much better than we were looking back here or back here. We're definitely forming some structure and waiting for this breakout. And I'm not discussing Nasdaq yet because S&P is a bigger market, much stronger market compared to Nasdaq. So Nasdaq may give you false signals because I know a lot of you people are maybe thinking, oh, Nasdaq already broke up. Yeah, I can show you right now. It broke this trend line and it's now trading up, but it still hasn't broken this key level yet. And because it's only comprised of 100 top tech stocks, S&P is comprised of 500 stocks. So definitely we want to keep looking at S&P 500 more in these kind of environments because it's definitely going to give us more critical and better technical analysis compared to the Nasdaq. So now let's move over to some of the stocks and start with Tesla first. Tesla definitely looking good, but getting into the earnings. So as we already said, on Wednesday after the close, we have Tesla reporting earnings. The expectations is the earnings to be revenue of around 16 billion, and we'll see what Tesla reports. But you got Elon Musk, so probably you're gonna be okay because he's very good with the words, and I think yeah, he's just good. So anyways, the Tesla is forming kind of a wedge pattern. It's ascending triangle, basically trying to go up. Currently, we have a long leg doji on a daily time frame, so that's basically indecision. but I'm seeing some shorting opportunities right here. But the earnings is going to be very important. If it's going to break through, it's going to be because of the earnings. If the earnings are good, if it holds up, and Elon Musk has good ideas about Tesla, and which I don't know if he's going to talk about Cybertruck or semi or anything else, it can definitely push the stock up above 760. If the stock breaks above 760, that's going to be very good for the Tesla. So let's see if it does this. If it goes above, right, finds some selling, and then it basically breaks above, then you're hitting somewhere around 870 range. That's going to be your next target. So definitely a lot of percentage move that can happen with Tesla, sometimes around 15-16% if we get that move above 760. So that's for the Tesla. The other stock that I want to talk about is Nvidia. So a lot of people have gone bearish on semiconductor stocks, but I'm still bullish. I love Nvidia. It's one of my favorite stocks, and it's definitely come down heavily. We're currently at 157. So until I see Nvidia above 170, I'm not gonna be bullish on the stock yet. But things can change in a switch. Okay. So definitely do not be so bearish. And if you're in semiconductors like me, like Nvidia, we want to definitely see above 170, and then we can think about and definitely forming a structure. I mean, you can see on a daily time frame it's forming a higher low, right? So it's following the S&P 500 and it's not breaking down. So definitely semiconductors can lead the way, right? We just want Nvidia to break above 158, 160, and then get above, ultimately above 173. Once we start seeing this 20 and 50 turn around, that's where you're going to see, okay, bolts coming back on semiconductors. The other stock I'm going to talk about is Google, and we're coming into the stock split on Monday, so be careful. We're currently in a tight range, which is distribution, right? So definitely many people are going to be looking at Google stock to buy after the split. It's probably going to be around $120. So see where you want to buy the stock. It's probably going to be, this is going to be a good level to buy the stock, and this is going to be a good level to short the stock. So I'm definitely going to be buying some when the stock split, and we'll report more. So if you're definitely interested in these kind of stocks, stay tuned, subscribe to the channel, and be part of the community. We're going to be talking about these stocks more and more in the future. All right, that's all for the guys today, and I'll see you guys in the next one.